Hey everyone, hope you guys are doing well and enjoying some of that beautiful May weather we've been having all over the country. In today's deep dive, we're going to talk about a lot of things, cover some data that's come out that is actually quite a bit more hopeful than what your talking heads on TV may actually be saying right now. So we're going to get into all of that and walk through that. But before we do, John, how you doing today?
Hey, I'm doing great. I'll tell you what, I actually had turned off the TV and turned off the radio news probably about 5 or 6 months ago. I'm not an ostrich in the sand. I simply look at facts. I listen to people that give me facts, and from there we end up making good decisions. And so I'm really enjoying life right now.
Yeah.
If I can get past my Cardinals being the worst team in baseball,
Oh, I know. Brutal. But hey, they won two in a row against the Cubs, so we'll take it. That's progress, right?
they took the last game against Detroit, so they've won three in a row. So we'll see how they do coming up against the Red Sox this next week, and hopefully he will make some good positive improvement. And sometimes it's the darkest before we see the morning light, and maybe that's what we're going to see with them. And we've definitely seen that as far as in the economy here recently.
Yeah, we definitely have, and so we'll definitely get into it. I would be remiss though if I didn't point out I do have a buffalo behind me. So if anyone's wondering, that yes, that came with the home I just purchased. It will not be staying, but Chief is one of my favorites. So I left it up for the time being. So
Drew, I would leave Chief up there. Well, I mean, what's the point of taking him down? He's a
I,
beautiful beast.
it looks great, right? Yeah,
Yeah,
he's a talking piece. So we'll leave him there.
yeah, for sure. Nice.
So, all right. Well, hey, let's jump into it. We're going to put a chart up on the screen here that's going to talk about the performance of the market over a 1 year period after CNBC runs their classic markets in turmoil segment, which, if you've ever watched one of those, it sounds like the world is ending. It sounds like the market's crashing, the economy's grinding to a halt. But the reality of this chart, as you can see, it's all green. John, whenever we look at this and compare it to kind of what you're talking about, some of the talking heads on TV, what are we supposed to do with this? Because right now, a lot of clients I'm talking with, myself included, things sound really bad right now. So how should we kind of interpret this?
I'll tell you what, Drew, I've lived professionally through so many cycles. I mean, this is going to age me. I started in 1991. And so, goodness, that's 22 years ago this spring is when I started working in the equity markets. And I want to say I've seen it all, but I've pretty much seen it all. And so, just in case you're wondering how old I am, whenever I get my hair cut right now, I cut it really short so you can't see all my gray hair. And so I always give Nikki, my barber, a hard time that she's turning me gray. But reality is that means I have a lot of experience in the markets, and I've seen so many negative things. And I've learned many years ago that with the media, when it comes time to their real job, they're really there to make money for shareholders or for ownership. And the way media companies make profit, they have to sell airtime. They have to sell advertising to get. And so in order to sell advertising, the way they can charge more for their advertising for their 30-second or 1 minute clip is by having more eyeballs on their channel. The way they get more eyeballs is by being very extreme and reporting extreme elements for people to freak out. And oftentimes it comes with music, it comes with a lot of different graphics that are red, with lines going down, with apocalyptic pictures going in the background. That may or may not be reality. And the reality is, a lot of people say they don't trust large media companies. You can't never trust what they have to say. And yet, I find so many of the folks that say that actually are the most gullible when it comes time to listening to radio programs and television shows. So personally, I have moved away from that, and I've said, whenever you see something and you hear someone talking about how horrible the economy is, and then 30 seconds later there's a commercial talking about buying gold and silver because everything is crashing, you have to say, are they really a fiduciary? And
Yeah.
the reality is they're not a fiduciary, because a fiduciary would not prey upon people's emotions. So they're not looking out for your best interest. They're simply selling advertising time. I know a lot of people follow a lot of different talking heads on the right side, on the left side. And the reality is they're there to sell media. And so in order to do that, they've got to get people watching their shows and make extreme things. And Drew, that graphic is just, I mean, I don't want to say I laugh at it. Sometimes I cry at that,
Yeah.
because that's a perfect example of what CNBC does. And quite honestly, folks, if you're watching CNBC, I always call that financial porn. There's no redeeming value out of the fake stuff they put up there.
Yeah.
And all they're trying to do is they're trying to make some screaming headline because it's not fact based. Because when you look at this chart of what actually has happened after they put their world is coming to an end special out there, 1 year later, the average rate of return, Drew, I don't know what that is. It's so small, up 40% on the
Yep.
average 1 year return after the world is coming to an end special.
Yep.
And it's been going on for 15, 20 years.
Yep. And, like you said, they do it because they're selling advertisements. That's what they are. Maybe there's a little bit of truth in what they're saying, but the reality of this chart tells us, what, as you said earlier, it's darkest before the dawn, right?
Mm-hmm.
And so usually when things sound the worst, there are reasons to be positive looking forward. And John, I think this is a perfect transition point. Let's talk about some of those reasons. We've talked a lot about the price of eggs. We've laughed about it somewhat. This chart that we have up here on the screen actually shows what has happened to the price of eggs so far in 2023. And the thing that's most interesting to me is the price is now below the 3-year average price of eggs. And we're seeing this across a number of goods and services. Prices are coming down. Inflation is coming down as well. And so when we think about a lot of what we talked about in the last year is inflation and how to bring it down and the impact that has on the stock market as a whole and on bonds. John, when we look at this chart, what are we kind of thinking as it relates to the economy broadly and forward-looking when it comes to investing?
I think what this chart really tells us is that outside forces for a short period of time greatly impact overall prices of all goods and services that we buy. Now, long-term inflation is really driven based upon long-term dynamics regarding the demographics that we have at play. And so whenever we look at the price of eggs as an example, why do we see that unbelievable increase last year? Well, that was really had to do with a bird flu breaking out and 90% of hen layers actually having to be exterminated. And so that cut down the amount of eggs in the system. So whenever supply goes down and demand stays the same, that means prices have to go up. But as the flock of egg layers actually has gone back up, well, then we see the cost coming back down. Right. Reality is that does not mean that people have stopped eating eggs. I mean, some folks may have decreased a little bit. I know for myself, I eat the same number every single day that I've always had for the last 3 years. And so reality is it does play into it, but it's external forces. So let's talk about it, overall inflation, Drew. I think this is a great segue into that. So what caused the hyperinflation that we saw in the marketplace through all of 2022? Now, keep in mind, inflation, the price of goods and services is still going up. We had a softened number come out on the 10th of May on Wednesday. And that soft number really said that inflation was still there, but it was going up at a slower pace. And the annualized pace, I believe, is 4.8% on the year-over-year number. Yep. Well, that's down from the upper 8% that we were running for 4 and 5 months in the fall of last year. Well, why is that? Well, let's kind of take a step back. All the governments of the world, they shut down the world economies, which shut down production and then transportation or logistics. And it did that during the COVID season, and we're going to call that from 2020 through 2022. And there were starts and stops all the way, but you cannot stop the entire machine and then start it right back up again. Yeah. It takes time for that to work through the system. And so we did have a supply issue with lower levels of goods in the system. But then we also had a higher level of cash in the system. M2, which is one of the measurements of the money supply, it had reached the highest levels of dollars in the system ever. Right. But they have been extracting, Drew, at the pace of $85 to $100 billion a month out of the system. And so M2 has actually been decreasing. If there's more dollars in the system, which are demanding a lower supply of goods, the price of those goods is going to go up drastically. But as we have more goods coming into the system, because of logistics, because of manufacturing getting back up and running, but then all of a sudden the amount of dollars in the system is going down, well, then inflation is going to drop down. Now, not to freak anyone out, but the reality is inflation, the Federal Reserve has benchmarked, rightly or wrongly, quite honestly, over the last 2 decades, they've benchmarked a 2% inflation rate as their target. And the reality is, I can see us getting back to that on long-term, averages.
Yep.
But the reality is, we actually may hit a deflationary period for a short period of time, for 3 months or 6 months, simply because as things are continuing to even out overall economically, we may end up getting to that. But that's going to be a short-term aberration. Do not allow the media to tell you what a horrible situation that is.
And John, can you kind of walk through what deflation is? I think when you hear that phrase, you could go a number of different ways with it. So, what is deflation? What does it mean to the economy broadly?
So inflation, as it relates to the prices that we pay, that means that the price of the good that we're purchasing is going up in price. Deflation means that the price of the good that we're buying is actually going down as far as in cost or in price. Now, there's many reasons why a price may go up or down, but ultimately it all revolves around demand for that product. However, we may see demand for the product going up, but the input costs going down. So let's just say, as an example, that because of technology, the manufacturing cost of producing a widget goes
Yep.
down as far as the cost. We see it with televisions all the time. We just picked up two new televisions out there in our office in Avon, Colorado, and the price was lower than what it was 3 years ago, even though inflation is going up. Well, why is that? Well, the cost to get the materials and produce it actually went down.
Yeah.
So the cost is lower, but then let's say that the price of diesel also goes down because it was at an elevated level. Price of diesel through this production goes down. That means that the cost of logistics or transporting that television set from where it was manufactured, probably somewhere over in the Far East, put onto a container ship, shipped across the coast, and then probably they're trained or else trucked up into Avon, Colorado, is actually cheaper now than what it was 9 months ago when diesel was sitting there at 5.40 a gallon, and today it's
Yeah.
at 3.20 a gallon.
Yeah.
And so the input costs are lower, so that may cause the price of a good to decrease, even though there's still demand for the product.
Yeah, makes sense for sure. Now, John, you talked about getting back to that 2% inflation number in time. We don't think that's going to happen, let's say, by the end of the year. And a big reason for that, we have an analyst in house that now works with us who tracks a lot of different economic data. But what we're seeing with employment numbers, we had a very strong employment report last week. So more people are working than what is expected, meaning they're earning more money that they can put back into the economy. Industrial production is up. Home sales, after being massively down in 22, are back up again. So when we think about that, what does that mean for the economy? Well, it means more people are putting more dollars into the economy, which means there's more economic growth, there's more earnings growth for companies, which from a stock market standpoint, John, that's a positive, right? But from an inflation standpoint, that means inflation's not going to drop as quickly as what some people would like it to. So that sounds like great news, right? But how do we square that with all the negativity we're hearing around inflation and high interest rates? How do we balance those two things right now?
Yeah, inflation is damning long term. I mean, it doesn't matter what it is you do. If you're a consumer, if you run your home, if you are running a business, if you're in the government, inflation itself is really a very damaging thing. And so we know that long term. And so that's why we need to have a modest inflation rate. And typically, why would we want no inflation rate? Well, inflation typically goes hand in hand as far as growth in the economy. Now, not always, but that's a typical
Right.
sign that we see. And so we want to see the economy continuing to grow, and we'll have to get somewhere in that 3 to 4% range as far as growth in the economy. It'd be great to be sitting there. As far as on a long-term growth rate, that means the economy is continuing to expand. It expands either through advances in technology, and some of the time, Drew, we should probably talk about AI and how
Yep.
the impact that that's going to be on the economy as that continues to grow and develop. But also, then we see more people working right now. So that means that this is great. That means that they are also growing their earnings potential. And so we see the average hourly rate and average number of hours increasing across the board as far as in the economy. Those are very positive things. And so because of that, we're actually seeing the economy growing at a decent clip this year. Reality is right now, I mean, there was a lot of projections If you were listening to certain radio or television stations, they were projecting that we're already into a deep recession or a recession,
Yeah.
and it's going to get deeper. We have a lot of people that are probably more moderate in their view that really were projecting that we're going to see a shallow recession. And I'll talk about recession here in a second. And then there were the folks that were on the other side that you listened to that said that we're not going to have any recession at all. As a matter of fact, we're going to see unprecedented growth in the economy. So you want to make sure the numbers of the folks you're listening to are really balanced. But at the end of the day, we have to say, well, with the economy expanding, now the reality is a lot of folks look at what I'm going to say a back of the envelope definition of a recession, which is 2 quarters in a row where we have negative growth. Well, that's not a textbook definition of a recession or an expansion in the economy. That's a layman's term. The reality is a recession is only defined after the fact,
Yeah.
and it's a board of economic governors that are actually totally not tied to any governmental entity. And what they're looking at is a number of metrics that have to do with employment, not unemployment. It has to do with expansion or growth in the economy. And it has to do with what's the actual interest rate movements. And so it would surprise a lot of people to know that the last recession that we had on record was March of 2020.
Yep.
March of 2020 was the last recession that we had on record. Well, how long did it last? Did it last for 2 consecutive quarters? Did it last for 4? No, it lasted for 1 month. It's because of the shock in the system, unemployment was so high, and the economy cratered for 1 month. And then after that, the economy started picking back up again. So I think we need to say, where are we at right now? Drew, it's with everything that's happening, interest rates. I'm looking at charts right now and seeing where we have interest rates at the very moment. I mean, we've seen a slowdown in the increases. It's looking like the Federal Reserve is pausing the increase in interest rates. With the numbers that came out on May the 10th, I think that's going to continue as far as on the increases. If we see inflation numbers continuing to come down, which is a very real possibility, we see interest rates starting to come down, we see employment continuing at the same pacing. The reality is we may be done with this interest rate increases, and we could be heading to a period of time somewhere in the fourth quarter or possibly beginning of the first quarter of 2024, a decrease in interest rates.
Yeah.
And so it's looking like that's what we're going to see. We're not going to hit that recession period. That's what most people would see as a negative.
Sure. And, it's always possible something changes, right? The world is constantly changing. So it's always possible that, who knows, the Federal Reserve does something not intelligent and that puts us into a worse place. But right now, the numbers we're seeing, it's actually saying, hey, there's a lot more hope out there than what the talking heads on TV are actually talking about. And, you should have received an email if you're a client of ours from your advisor this week, talking about some changes that we made in your investment accounts. And those videos walk through the rationale and the positioning inside of your accounts. But John, why don't you just broadly high level it for everyone in case they haven't seen that video, kind of based on what we just talked about here?
Yeah, we're still continuing to see just a resetting of all financial markets right now. And so what that means is on the fixed income side, we went ultra short last year and a half, actually, in anticipation of interest rates increasing drastically. That benefited our clients greatly. With interest rates starting to level out, we're starting to see, we'll call it a feathering of a little bit longer, more intermediate term maturities to give us a little more yield potential to lock in. So we see that there. When it comes to our passive ETF allocation, which is all equity based, we have an overweighting right now on the S&P 500 and the NASDAQ. Those 2 indices are outperforming the Dow Jones Industrial Average and dividend payers. And so that's actually been an overweighting we've had for the entire year, which has benefited us nicely. We still have an allocation there, a 7.5% of international. The U.S. dollar did decrease from $114 versus $100 in a basket of currencies down to $103.40. And we're looking at going to stabilize there. And so because of that actually made U.S. imports more valuable. And so with that, we are seeing international outperforming U.S. Here in the next 3 to 6 months. And so we still have a weighting there. As it relates to the sector rotation ETF strategy, we had a number of shifts there. It's interesting. Right now, the one area as far as sectors that has the highest level of momentum is actually water. And so
Yep.
companies that are in the water energy space as a utility. And so that's providing tremendous growth potential on the upside. But we're also seeing technology. I mentioned that last year the NASDAQ was down 35% in 2022. And a lot of that was driven by fear, quite honestly, which was created by the media, in our opinion. It should have been down with the increase in interest rates, but not as far as what the emotion drove it to. And so we're seeing a bit of a snapback. We're also seeing phenomenal earnings in technology companies, and it's very, very resilient as far as on the earnings, for as negative as what some people believe the market is at right now. And in addition, we're also seeing not just earnings in the current years, but we are also seeing tremendous innovation, which is really positioning them for great earnings in the future. So across the board, Drew, we've had some rebalances. We're seeing some good growth. Right now, it appears to be less volatilities coming from the technology sectors. And so I would say across the board, if you're looking and you're saying, I might want to make some adjustments, definitely talk to your advisor about that. Keep in mind, folks, you cannot control rate of return, but what you can control is the level of risk that you take. So think about a dial, and you can simply turn the dial up on risk or down on risk. And right now, portfolios that have turned up risk a little bit, we're not talking getting crazy on risk, but introducing some exposure as far as on a sector rotation, but specifically in technology, those are the portfolios performing the best right now.
Yep. Great summary on that. So if you have any questions, absolutely reach out to your advisor. They're more than willing to walk through that risk conversation with you. We have some great tools to really help visualize that and make that conversation much more simple and in line with those longer term financial goals that you have. So guys, thanks for the time. We're over 20 minutes here, so we're going to wrap it up. We covered a ton of ground, but as always, if you have any questions, don't hesitate to reach out to us. We'll include a link to our True Wealth Live event where we were joined by Chief Market Strategist at First Trust Portfolios, Bob Carey. Bob talked about a lot of the things we just talked about as well. So I'd absolutely encourage you to check that video out if you have not seen it as of yet. So thanks for the time, everyone, and we'll talk to you soon.